Hello, and you're welcome to a special episode of Global Business Insights, focusing on yesterday's European Central Bank monetary policy meeting. But first, some of the other global headlines. The Reserve Bank of India today left the benchmark repurchase rate at 6.5% as expected, and also given that rapid economic expansion gives room for better focus on price stability. And in the US, with latest data mostly pointing inconclusively to a slowing economy, today's jobs report becomes important. Ahead of the jobs report, US markets closed mixed, the S&P 500 virtually flat, up just 0.02%, Dow Jones up 0.19%, and the Nasdaq down 0.09%. Yesterday, we got the number of Americans filing new claims for state unemployment benefits in the latest week, rising by 8,000 to 229,000 for the week ended June 1, also above expectations. Nvidia's market value has gone beyond $3 trillion to overtake Apple. That was just on Wednesday, as the world's second most valuable company, helped by an insatiable demand for its artificial intelligence chips. And yesterday, the South African Central Bank Governor Lesetja Kganyago warned the incoming government to recognize limitations in resources or risk having to be bailed out by the IMF as the African National Congress considers different coalition options. And in Nigeria, a few days to expiration of the 5-day ultimatum given by organized labor, negotiations remain inconclusive. Meanwhile, the Minister of Finance has presented a new minimum wage template to the President to be used for final negotiations. And to our main story and analysis, yesterday we saw the Stocks Europe 600 briefly touch an intraday high as the European Central Bank announced a 25 basis points interest rate cut. A cut is a cut, albeit this sounded like a reluctant or precautionary, or some say hawkish cut. Whatever you call it, just don't expect another cut soon. We will play a clip from ECB President Madame Lagarde's statement and comments from Senior Market Analyst Lukman Otunuga. Remember, we look at the US non-farm payrolls data later in the day.
Thank you very much, and good day to all of you. Today, the Vice President and I are delighted to welcome you to our press conference. The Governing Council today decided to lower the three key ECB interest rates by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to moderate the degree of monetary policy restriction after 9 months of holding rates steady. Since our meeting in September 23, inflation has fallen by more than 2.5 percentage points, and the inflation outlook has improved markedly. Underlying inflation has also eased, reinforcing the signs that price pressures have weakened and inflation expectations have declined at all horizons. Monetary policy has kept financing conditions restrictive. By dampening demand and keeping inflation expectations well anchored, this has made a major contribution to bringing inflation back down. At the same time, despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year. The latest Eurosystem staff projections for both headline and core inflation has been revised up for 2024 and 2025 compared with the March projections. Staff now see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26. For inflation excluding energy and food, staff project an average of 2.8% in 24, 2.2% in 25, and 2% in 26. Economic growth is expected to pick up to 0.9% in 2024, 1.4% in 2025, and 1.6% in 2026. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The Governing Council today also confirmed that it will reduce the Eurosystem's holdings of securities under the Pandemic Emergency Purchase Programme by 7.5 billion per month on average over the second half of the year. The modalities for reducing the PEP holdings will be broadly in line with those followed under the Asset Purchase Programme.
As widely expected, the European Central Bank has cut interest rates by 25 basis points in June, marking its first rate cut since 2019. To make things clear, the ECB's Governing Council has cut the refinancing, deposit and marginal funding rates by 25 basis points to 4.25%, 3.75% and 4.50% respectively, marking its first cut since March 2016 for refinancing and marginal funding rates and since September 2019 for the deposit rate. The central bank stated that it will follow a data-dependent approach and it is not pre-committing to a particular rate path. Interestingly, the inflation projections for 2025 was raised to 2.2% from 2%. During the press conference, ECB President Christine Lagarde adopted an upbeat tone on the European economy recovery, but also highlighted economic risk remain tilted to the downside in the medium term. The euro initially jumped over 30 pips in investors' mode over when next the ECB will cut interest rates in 2024. Traders are currently pricing in a 95% probability of another 25 basis point ECB cut, not in July, but in September. Now, the biggest takeaway from this event is the European Central Bank officials are all but excluding a second interest rate cut in July. And some will still question if such a move would be wise at the following meeting in September, according to people familiar with the matter. Another thing is the discussion on Thursday barely considered the possibility of a reduction next month, and there's currently no settled consensus on decreasing at the subsequent gathering on September 12th, where they issue the next round of quarterly forecasts. Ultimately, following the European Central Bank meeting, markets gave a tepid response as this was widely expected, with the next key event, the US jobs data on Friday. Speaking of monetary policy, first it was the Swiss National Bank, then it was Sweden's Riksbank, now it's the Bank of Canada cutting interest rates. In the G7 space, it is the first to cut interest rates by 25 basis points, as widely expected by markets and economists in a Bloomberg survey. This will be the central bank's first rate cut since 2020. Now, the Bank of Canada cut interest rates as it sees a soft landing on the horizon, with officials more confident that inflation is headed to the 2% target. With further and more sustained evidence underlying inflation is easing, Monetary policy no longer needs to be as restrictive. This was words said by the Bank of Canada head, McClam, in an opening statement. Now, although officials have flagged global tensions, a faster than expected rise in home prices, and high wage growth relative to productivity as potential risks to the outlook, it looks like more rate cuts for the Bank of Canada are on the horizon. Traders are now pricing a 62% probability of another 25 basis point rate cut by July, with a move fully priced in by September. This week, we've seen the Canadian dollar weaken against the most G10 currencies based on the decision. Looking at the dollar versus the Canadian dollar, it could trade lower based on a possible policy divergence between the Federal Reserve and the Bank of Canada. Speaking of monetary policy, let's look at the roles of central bank. This leads us to question what central banks are doing at a time where inflationary pressures seem to be cooling and economies are showing signs of weakness. It's worth keeping in mind that central banks play a crucial role in ensuring economic and financial stability. The use of monetary policy to manage economic fluctuations and to achieve price stability. We have seen the likes of the SNB, Riksbank, Bank of Canada, and now the ECB flex their muscles to promote stability. Still, all eyes remain on the Federal Reserve, which is seen as the leader of the pack. Overall, the market reactions to today's or to Thursday's ECB's decision, we saw treasuries join a slide in global bonds. And after the European Central Bank raised its inflation forecasts after delivering the widely expected interest rate cut, the euro slightly rose as investors mourned at the possibility of when the ECB is going to start cutting rates again. In the US, the US jobs claims top estimates, US labor cost increased by less than previously reported, and the trade deficit widened. But ultimately, all eyes will be on the US jobs report on Friday. Closer to home, in the United Kingdom, it's all about what the Bank of England will do next. The central bank is not expected to cut interest rates until September 2024, with this potentially being pushed back later if inflation ticks up. Elections in the UK present an element of uncertainty and could be something that may impact when the Bank of England joins the rate cutting train. But the question is whether it will be a core event that will jolt UK financial markets in 2024. Nevertheless, the annual rate in the UK eased to 2.3% in April 2024, the lowest since July 2021, compared to 3.2% in March and market forecasts of 2.1%. Much focus will be on the next CPI report published on the 19th of June for more clues on when the Bank of England will cut interest rates in 2024.
Asia Pacific stocks are mixed as investors looked at economic data from China and also digested Japan's pay data as well as the recent ECB rate cut. China's May exports beat expectations, climbing 7.6% against the 6% expected, still much higher than the 1.5% rise we saw in April. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Thank you very much for watching. Bye-bye.